Morning, guys. It's Thursday, May 22nd, 5:27 a.m. Central Time. Grain market's a little bit lower this morning after a rally yesterday. July corn futures down 2 3/4 at 458 1/4. July soybeans down 5.5 at 1057 1/4. July Chicago wheat down 7 at 542 1/2. July Kansas City wheat down 6 3/4 at 533 3/4. July spring wheat down 5 cents at 599 1/4. We're going to start in a place that we don't normally start at, which is with the bond market today. But I promise you guys there is a grain market tie-in that we'll get to in a couple of stories, so bear with us here.
The bond market sell-off intensified on Wednesday amid rising yields and debt concerns. The yield on the 30-year U.S. Treasury rose to 5.089%, the highest level since October 2023, and a level rarely seen in the past 20 years. Meanwhile, the 10-year yield rose to 4.595%, breaking through the closely watched 4.5% mark. The spike in yields was triggered by a weak 20-year U.S. bond auction and record sell-offs in Japanese government bonds. Volatility in the bond market is being driven by numerous economic pressures, such as rising U.S. debt and tariffs. Investors are now demanding higher long-term returns to compensate for the risk, reflecting growing doubts about the government's ability to manage its debt and the safety of treasuries during tough economic times.
Okay, so what happened yesterday? I need to go through this slowly because it's a lot to explain. What happened yesterday is the bond market sold off and U.S. Treasuries just in general sold off. Interest rates are rallying. Let's go right into the next story, which is related, and then we'll talk about it some more.
So, House Republican leaders are urgently trying to pass President Trump's domestic policy package. The multitrillion-dollar bill includes tax cuts, increased military and immigration spending, and cuts to Medicaid and clean energy programs. The legislation is facing opposition with the Republican Party from spending hawks demanding deeper cuts and blue state Republicans pushing for a larger state and local tax deduction. Due to the narrow House majority, the bill can only afford to lose 3 Republican votes. According to the Congressional Budget Office, if passed, the legislation would hurt low income Americans while benefiting the wealthy. Even if the House passes the bill, Senate Republicans plan to revise it.
All right, let's look at a couple charts. The bond market is concerned that this tax bill, budget, whatever you want to call it, it's going to result in more debt. And that's part of the reason that the bond market is selling off. And I put a 30-year chart up on the screen. I mean, you can look at a 30-year, you can look at a 10-year. They're selling off because there's concern about rising debt. There's concern about the tariffs. This kind of sell America trade, as I mentioned earlier in the week, is back. This is a daily chart of the Treasury bond futures. Here's a monthly chart. If you were to break out below that 2023 low, that would be a very bad look. Let's look at the different version of this, or look at this through a different lens. When bonds sell off, interest rates rise. Yield on the 10-year U.S. Treasury this morning is close to 4.58%. Premium subs, you guys know this, and you have seen this video. We did a video with our friend Jim Urio, who's a professional interest rate trader, super sharp dude. And it was called The Biggest Thing That Nobody Talks About. And it relates to commodity prices and interest rates. And Jim's theory, and I don't want to put words in his mouth, but his theory is this. If interest rates get too high, say the 10-year gets above 4.8, maybe up to 5%, the Fed, in all likelihood, will be forced to step in and buy bonds in order to keep interest rates low. Why do they do that? Why would the Fed buy bonds, and why does the Fed want interest rates low? If rates get too high, a number of things happen. Economic growth slows down drastically. Government borrowing costs get very, very expensive and get more expensive if the rates get too high. Consumer spending slows, a lot of business activity slows. So if you get to a point where, call it the yield on the 10-year Treasury gets up above, maybe it's 4.8, maybe it's 4.9, maybe it's 5%, there's a very strong case to be made that the Fed will step in and buy U.S. Treasuries in order to reduce the interest rates. It's happened before. It'll happen again. I emailed Jim yesterday about this, and I'm going to tell you what he told me. And I'm just going to read what the exchange here. Jim won't care because he's said this in our premium videos a whole bunch of times. This was the question I asked him. I said, Jim, grains were up sharply yesterday. Grain analysts don't have a great reason. lots of chatter about the Trump tax bill, expanding debt, et cetera, rising rates. I said this: how confident are you that money managers are buying some commodities because of the weak dollar, higher rates, and debt concerns? Gold acts well, grains well, energy's poor, Bitcoin higher. Jim responded and said this. He said, look at platinum as well. I think there's a storm brewing that was reflected in the poor bond auction today. If auctions trend worse, it creates the potential for greater Fed involvement. Commodities would do well in that scenario. So what I'm trying to say here is that I believe personally, and you can call me crazy if you want, I believe personally that yesterday's sharp sell-off in the bond market and the sharp rise in interest rates has something to do with the rally that we saw in the grain markets. So let's go to the corn market and we will elaborate a little bit further.
Corn futures surged yesterday, supported by strength in the wheat market. The July 25 contract gained roughly 7 cents to close at $4.61 per bushel. The rally was largely driven by U.S. dollar weakness, short covering, and slow farmer movement. Soybean and wheat futures also edged higher.
Okay, so I got 100 text messages yesterday. Joe, why was corn higher? Why is December corn rallied so sharply the last 3 days? There's not a good answer out there. You read the news wires, the explanation is, it's short covering. Short covering. Maybe they'll throw in something about weather, which I don't really see right now. You'll see maybe dollar weakness. My personal thought is that it does, in fact, have something to do with what's going on in the treasury markets. Let's go. So look at this December corn chart. You see the rally that happened there in early April. You had this sharp rally in corn that coincides with the sharp sell-off that you saw in the bond market in early April. And now you're back to a situation where, okay, corn's got a sharp 2 or 3 day rally. The bonds have a sharp 2 or 3 day sell-off. I think you're seeing an inverse correlation here. I really do. And yeah, I am every bit as dumb as I look and sound. But Jim and some of the people that I have become familiar with in the industry, I have some really smart friends, and this is what they're telling me. So can you ever guarantee with any degree of certainty why a market is doing what it's doing? No, you cannot. But in this instance, you've got a rally in the corn market that can't really be explained. And I think that what I just told you about the bond market, interest rates, the idea that the Fed could come in and buy U.S. treasuries, which is essentially money printing is what it is. It's friendly commodity prices. It is. And you've got a corn market that, you got tight old crop situation. I understand that the new crop projections are bearish, but those are just projections. So I think personally, there's some fund managers out there buying corn, buying grains, maybe just yesterday, but maybe it continues today. I don't know, because of this bond situation. So make of that what you will.
If you guys have not checked out our premium content, you sure need to do so. Joe, can you tell our viewers about yesterday's premium video?
Brian and Mackenzie did charts yesterday. I do take a day off from doing premium videos every now and then, but Brian has some thoughts about how much a weather event could impact grain prices, and he hits it from a technical standpoint, not from any other standpoint. And when there's a lot of noise or even lack of noise, I think that peeling it back and just looking at the charts is a very wise way to approach analysis. And Brian is the best in the business as far as I'm concerned at doing grain charts. I'm going to do grain marketing review today. If you guys want to know what I'm advising and what I have advised with regard to cash grain marketing, I'm going to do corn and soybeans today. You may want to sign up today to see that video. Basically what I do with cash grain marketing is I just advise orders. I say, hey, we're going to sell 10% of our expected new crop corn production at X price. It'll give us an average of X price on this percentage. And I'll tell you what the game plan is moving forward. It's very, very simple. No complicated futures or option strategies, nothing like that. It's an absolute piece of cake. So if you are looking to simplify your marketing, and you should simplify your marketing, you should check out this deal. That video will go out at 10 a.m. Central Time today. $50 per month subscription. You can cancel at any time. As I've said in the past, we won't try to sell you anything else. We don't want to do your brokerage or sell your crop insurance or anything like that. We just want to send you our info. So give that deal a shot, and you will see that grain marketing video later today.
The National Grain and Feed Association has voiced opposition to expanding futures trading hours. In April, the Commodity Futures Trading Commission, the CFTC, requested public input on the potential benefits, risks, and uses of moving to extended trading hours. The NGFA argues that such a shift would disrupt current risk management practices, raise operational expenses, and increase unnecessary market exposure. The CFTC chairman said the organization is considering 24/7, 24/6, and 24/5 trading hours. claiming that the expansion would keep the markets vibrant and resilient while ensuring investor protection. The proposal would apply to futures contracts of grain, oilseeds, and livestock.
CFTC put out this request for comment on April 21st, and they basically said, like, we're considering a drastic extension of trading hours in commodity markets. The CME group was not mentioned here, but the CME group is the one who would benefit from this because they would see more, in all likelihood, more trading volume. The last thing in the world that our grain markets need is more trading hours. We don't need more trading hours. We have too many trading hours. The last thing in the world that the cattle market needs is more trading hours. Personally, if it were up to me, corn, soybeans, and wheat would trade about 5 hours a day. Cattle would trade about 4 hours a day, and that would be it. I think the trading hours are already too long. You have these enormous lulls in volatility and volume that happen during the overnight session sometimes. I just don't think that it's necessary. This is a money grab, is what it is. CME wants more money. CME is a publicly traded company. And honestly, the Chicago Board of Trade and the Merck, they used to be great businesses, and now they're publicly traded. They are only out for the shareholder. They are not out for you. So I agree 100% with the National Grain and Feed Association in their request to reject any extension of trading hours. If anything, they need to contract the trading hours.
U.S. ethanol production increased last week. Weekly output of 1.04 million barrels per day was up 4.3% on the week and up 1.7% versus the same week last year. Ethanol stocks were pegged at 24.94 million barrels. The print was down 2% compared to the previous week, but up 3% compared to the same week last year. According to Reuters data, U.S. ethanol production margins have softened over the last week.
Yeah, production's still pretty good, though. I mean, we're running where we need to run to hit USDA projections. Stocks are a little bit higher than I'd like them to be. That's the highest level seasonally of the last 10 years. We're hoping that some of this trade stuff ultimately, I mean, there's a lot of hope when it comes to the tariffs and trade. I mean, the bigger hope is that we reach a deal with China and others that would result in, purchase agreements for corn, soybeans, wheat. But ethanol is something that we could export more of. And there's a number of different countries who are candidates to import U.S. ethanol. And we hope that maybe we get to that point.
Dry weather is expected to benefit Argentina's crops following several days of heavy rainfall. According to the Buenos Aires Grain Exchange, the return of drier conditions is a welcome development, particularly after the northern region of Buenos Aires received nearly 16 inches of rain in recent days. The excessive rainfall has further delayed the soybean harvest. The exchange, however, is forecasting little to no precipitation across the country's key agricultural regions in the coming days. Despite the recent weather setbacks, the exchange continues to project this season's soybean crop at 50 million metric tons.
So this was cited yesterday as being one of the reasons that perhaps the soybean market rallied, even though it's really old news. And I mentioned this early in the week. So they had these floods, and my thought was that, okay, if the market's really concerned about this, you're going to see a sharp rally in the product markets in meal and in oil because Argentina is the top exporter of those products. You saw no such rally. And then, yeah, there were some comments from the grain exchange down there that, this could result in reduced production. I just don't know if I see it. We had a map. It was either yesterday or 2 days ago with the observed precipitation totals. And my take on it was that the flooding and the super excessive stuff was too far east of key corn and soybean growing areas to really make a big impact. So I don't know. I feel like they're trying to make a story out of something that maybe isn't as big of a story. I know that we have some viewers and listeners who are in Argentina. So if you guys think that I'm absolutely nuts and that this is a huge story, drop me an email or something in the YouTube comments here.
Bitcoin rose to an all-time high on Wednesday. The cryptocurrency briefly climbed 2.7% to $109,856 before pairing gains. The rally was fueled by optimism over advancing U.S. stablecoin legislation and hopes for regulatory clarity from the Trump administration. Bullish sentiment is building among option traders with significant open interest in contracts targeting prices between 110,000 and 300,000 by late June. Investment in Bitcoin futures and ETFs has also increased sharply. So far this year, Bitcoin has gained about 18%.
New all-time highs. We're up 18% year to date. You're up 65% over the last year. I feel as if this also ties back to the bond market story and the potential for Fed purchases of U.S. Treasuries and how that would be seen as a money printing / inflationary type deal. And I think that in that scenario, Bitcoin performs well. It's continued to perform well, but I think that this action this week in a vacuum can perhaps be attributed to some of those same ideas. What did cattle do yesterday?
Cattle futures were a mixed bag. Live cattle saw gains ranging from 22 cents to 97 cents. Feeders, meanwhile, saw losses ranging from 87 cents to $1.32, with the exception of the May contract, which gained 30 cents. Box beef was higher once again. Choice was up 84 cents at 359.59, and Select was up 332 at 348.28.
Outside market's kind of quiet this morning. The Dow's off 30 points. The S&P's up 7. Treasuries are mixed. U.S. dollar's up a little bit. Crude oil is down $1.14. In the July WTI at 60.43. Have a great day, guys. We'll be back on Friday.